Good morning, ladies and gentlemen. Well, this week we have Jay Powell at Jackson Hole, and he's going to be talking about R star. Now, the background is that we have a model which is rapidly going back towards cash in equities. And now let's have a look at what R star actually means and how I managed to get a first at Cambridge in economics without ever knowing what R star was, because really it's a load of bollocks. But it's a load of bollocks that we need to care about next week, because the implications, if he says that R star is higher than previous estimates, means that we are not restrictive enough in monetary policy, or that we're not restrictive enough for long enough. There is a big difference here. He might say that we are restrictive enough, but that we need to be restrictive for far longer. And that is going to have major implications for the yield curve and especially for SOFR spreads. The Fed loves a good argument about R star. So I'm not going to define it, and I'm not going to go through the different models that try to measure it. I've included the links in the summary sheet, and you can do that in your own time. But let me give you a synthesis of why it's important, and it's basically to do with this chart. Nobody knows what R star really is, and nobody's really observed it in real life. It's a unicorn. It's something that only policy wonks really care about. But if the Fed concludes, and by the Fed I mean Jay Powell, concludes that the natural rate of unemployment, sustainable growth and employment and interest rates is higher than they think it is, that means that policy is less restrictive than they think it is. Basically, on this chart, it just means that this line, the tightness relative to the medium natural rate at medium-term horizons, is lower than they are measuring it in this chart. And that the restrictiveness in quarter four of 2023, i.e. they think it's going to be up here, is going to be lower. That means that basically higher interest rates need to be there for longer, i.e. it's not going to take till quarter four of 2023 to reach a level which has been as restrictive as the year 2000, but it's going to take much longer, and therefore basically shifts all these dots lower. And that means that the spreads and what the market expectations can be of the Fed lowering rates must come down. That means that 2024 probably there will be no cuts, and 2025 means there will be less cuts. So the 2024 and 2025 SOFRs are going to get hit for 6. What does that mean? That means that the 2-year note screams higher in yield. Those are the implications of what he might say on Friday. And basically, since the whole conference is about the level of R star and are we correct in measuring where it is or estimating it, or is the natural rate higher? That is the implication. If he says R star is higher than we've been measuring it so far, that means that everything in 2024 and 2025 needs to get hit, because these dots come all the way down here or wherever, but they are lower, and therefore policy needs to be restrictive for far longer than the market is currently estimating. That's all you need to know about R star. And the market seems to agree that R star is too low and basically is taking real rates higher. This is the inflation index 10-year constant maturity, and as you can see, we are making new highs. We're at 197, and the previous high was around here, what was it, 174. So real rates are going higher. Now let's have a look at, let's go back in time and let's have a look at where we are relative to previous periods. We are now back to where we were pre-GFC. We are at levels consistent with 2001, 2002, 2003, when policy was restrictive. 2003, 2004 were periods where the Fed was still hiking rates or keeping rates high. So basically the market is saying that we are back to restrictive times when real rates need to be 2% or higher. Now, 2% real rates, give it 1.5% on top of that for Fed funds. That means that the bottom of Fed funds is somewhere around 3.5%, which is not what the SOFRs for 2025 and 2026 are saying. So you understand why they're going to get hit. And basically what we are saying is that we are not going to have lower rates for very long, i.e. so rates are going to be higher for a very, very, very long time. That's what you need to understand about this argument that is going on at the Fed and that Jay Powell is going to speak about on Friday. If we have a look at the five-year forward inflation expectation rate, they're staying constant around the 2.5%, while they would like it all the way back down to 2. So if we have a look at where we were in 2004, 2005, we were right around here. And they would like to keep it, lower, but they are not achieving it. And so probably they need to keep the terminal rate. Whether we're at it or whether we have another 25 basis points is neither here nor there. But the important thing is that it will be held at that level for far longer than the market estimates. This is what all these real charts are showing you, with even the 10-year break-even inflation rate staying above the 2%. So everything is basically saying, and you can see where we are. We are right back to where we were in 2003, 2004, 2005. We are back at pre-GFC levels, and that is where the market is basically saying we are, at pre-GFC levels. Now, of everything. If that is the case, let's have a look at what bond yields should do. Okay, so this is a monthly chart of the 2-year note yield. And if we have a look here, I think that 527 is basically as high as it can go. How is it going to get to this 527 level? Well, basically it's going to happen through the 2024s and 2025s coming down. If you think of SOFR, 2024s and 2025s, they're the ones who are going to get hit, because basically what he will be saying, if he says that R star is higher than they've been estimating it, that would mean that the cuts are going to be slower and later, and therefore you're talking about the 2-year note getting hit towards 527. Let's have a look at that on a daily chart, what that means. That means basically that we're going to have a very abrupt move to new highs. And that is what you should expect. You should expect the 2-year note to be particularly badly hit in terms of the yield curve, i.e. you probably get some flattening, because the bond, the back end of the curve should like that kind of a talk. And really the 2-year is going to be the one that gets hit. So if we have a look at the 5s, let's have a look at a monthly. And here we are. This is the kind of level we were, in 2024, we are really not that far away. So you can see that the fives react less. They might go to new highs, but really it's going to be a twos move rather than anything else, because he's delaying cuts into the future. Therefore, the one that should suffer most is the twos. If we have a look at where we are in the tens and we go into the 1 month, are we that far away? No, we are, you're looking at 450, 458. That is the kind of level that you're looking for the tens. So, is the yield curve going to flatten on that? Yes, I would expect a couple of days of flattening of the yield curve on that. I just don't see why not. But what I'm also trying to say is that the fives and the tens are probably getting to levels where they're going to be a very interesting buy around this 458 level. I really don't expect them to go much higher than that. And if we look at the 30s and this is the monthly chart, you can see where it was, really this level around 470 is going to be very, very difficult to break. We haven't been above it for decades. And I really don't see any reason why the 30 years would go higher than that. I will be a big buyer of calls at that level should we get there. But basically the message from the monthly chart, it's all the same. We are within 25-30 basis points of a very significant top and potential buying level. Even for people who are chartists, if this is a 5-wave up, then we need the ABC back down. So to me, these upper levels that I've shown you in 5s, 10s and 30s, especially if the 2s go up and flatten the curve, that will be fantastic levels to buy in terms of risk reward. Because even if you think about it fundamentally, if the Fed says that something that nobody's ever seen or is higher than they thought it was, I mean, it might be, might not be, who the hell knows, certainly not some policy wonk, then that tightens conditions for the foreseeable future. And the tighter the condition for the foreseeable future, the more the long end of the bond curve should like it. And let's have a look at the yield curve. Now, I would definitely expect the first move, if Jay Powell really does say that we have, our start is higher than their previous estimate, the implication is clear, as I've told you, it's for SOFR 2024 and 2025. They need to price out the steepness of the cuts and the timing of those cuts. And therefore, the 2-year is the one that should be most impacted. It really means not a lot for the terminal rate, right? So the terminal rate should be still the same. And we have the dot plots at 560, i.e. one more hike. Now, whether we're going to get one more hike or not, I don't think the bond market really cares that much. If we get one, great. If we don't, still great, because as the Fed is data dependent, it means that inflation is not reaccelerating and there is no reason to do one more hike, because then the real rates would be far too high. The implication is for the 2024 and 2025 rate of cuts that the market has priced in. And therefore, for the 2-year, that should imply that the 2-year 10-year spread goes back up to this kind of level, 85 to 90. But I think that is going to be the final opportunity to actually get it to get into the steepener, because after that I think it has to steepen, because we will have actually what will we have done? We will have priced out the cuts that we expect to happen. So the risk reward turns back towards the economy doing worse than expected, or inflation doing better than expected, or both, and therefore restoring the cuts that we have priced out. Because once the economy turns, or if it turns, or inflation goes back to target, the Fed still needs to cut back to around the 3 to 3.5% level. And therefore, once we've priced out those cuts and the speed of the cuts, then from then on, the yield curve can but steepen. So I think that we might be getting towards the last opportunity to put on the steepener after he has said that the R star is too low, and therefore that we get the flattening. After we've got the flattening, all we have to look forward to is the steepening. But the first move should definitely be the flattening. And that the market is afraid of that, you probably can see in the 530s, which are at much more neutral levels. They're probably, they probably go back up to around here, 22, and then they start looking for opportunities to really disinvert over time. So to sum it up, the 2-year is going to be the most vulnerable, followed by the 5s, followed by the 10s, followed by the 30s. In another 25 basis points or so is a major probability of a top in the long end of the bond market, especially in the 10s and 30s, around the 450 something, and the 470 in 30s. And then after the first move, which is likely to be a flattening, is probably the last opportunity to get into the steepener. If we look at the SOFR, what are the implications? What needs to be priced out? Well, as you can see, Z23 is really not pricing in anything. H24 is pricing in very, very little. So the movements at the front are going to be very small relative to what is priced in. Where do cuts start getting priced in? Well, really from Z24 out to U25 or Z25. That is where the cuts are priced. And the implications of rates at the terminal rate for longer is that these spreads should all suffer. Now, whether the 24s suffer more than the 25s originally, or to start off with, I don't think is the important bit. If we have a look at something like U24 against U25, the first move is likely to be down here. Okay, and that probably, just like the flattening of the bond curve, is probably going to be the last opportunity we get, to buy it for the run up. Maybe not in U24, U25, but at some stage the cuts will be forthcoming, and we'll just wait for the curve to basically tell us when. But I definitely think that having some puts or put spreads in these late 24s throughout 25 before he speaks is not a bad idea. But what we have to understand is that, and let's have a look at something like H25, is that we have already expected and priced out a good, 40 basis points in the past couple of months. So the move that we're going to get is going to be 20, 25 basis points at the downside if he does say that R star is higher than previously thought. But it's not going to be a complete disaster. But the risk reward, if he says it, is to sell basically the mid to late 2024s and 2025s, because those are going to go down 20, 30 basis points. Now, I'm not going to show you the German yield curve because there's no point. It's best to show it against the US. So this is twos. The move is natural, it's that way. The moves fives, it's that way. The moves tens, it's that way. Now, what is important to understand is why is the move that way? A, because whatever the Fed says applies more to the US than it does to the rest of the world in terms of our start, although you would have thought that it applies equally around the world. Well, it doesn't. It applies more to the US because the US is, it's just in a different part of the cycle. It's a different type of economy. It's much more open, and therefore our star can be different. Theoretically, I mean, this is all theoretical anyway. So the natural move will be for it to impinge on the US more than it will impinge on Europe, and also it's natural that the supply, which is in US bonds, will affect US bonds and therefore the spread towards Europe. That's why I keep on saying the natural path of this spread at the moment is higher. How much higher, I don't know. I think this 172, 173 trades for sure, simply because of the enormous supply we will be coming. Don't forget that last week I told you the bonds are now like buses. There's always another one round the corner, and there's always another auction round the corner. It's going to take months for us to have priced in a level at which we can take down all the supply. Now, whether it takes months to get to those levels that I showed you earlier, I have no idea. I think those are good levels, certainly to start nibbling at bonds around 158, around 458 in the 10-year note and 472.5 in the 30s. Those are definitely interesting levels. And I think we get there with the US going up more than Europe. I think that is, it's really as simple as that. The US is the one that should be suffering most, and I don't see why Europe should suffer nearly as much as the US, because that's where the supply will be. In terms of the Dixie, I've told you that I think 172, 173 trades in tens, but that's, 9 basis points away. So I just don't see that is going to affect the dollar hugely to the upside, but it's certainly going to keep it supported. So really, this 1,282 level might be the bottom, and this around 104.20, 104.50 should be the top. And the 200-day moving average, which is below, needs to be turned. So it's going to take a long time before we can start going higher. And if we switch that to a euro, we need to bounce off this 200-day moving average, which is sloped upwards, and then start breaking it to the downside slowly and turning it and so on. So I don't think the move up in the dollar is going to be very strong. I think that we need a period of correction, bouncing off the 200, then bouncing off the whatever that is, probably the 50 and so on. So we need a period of stability before we can turn it. Therefore, I just don't see the dollar doing very much again next week, but I see no reason for weakness. The weakness can come from when we get to 173 and we've discounted in the tens, 173, tens, and we've actually seen that the top of the 10-year note and the top of the 30-year note at the levels that I indicated to you earlier, then you can probably get some weakness in the Dixie. But until then, I don't think it's likely. I think it's more likely to trade and stop everyone out around this 107.30 level uh, than anything else. Gold, well, you know what I'm going to say. I see absolutely no point in buying it until 10-year notes and 30-year notes have reached the targets that I've given you. You know, once you've seen something with a 450 handle in the 10-year note, you can start thinking about buying gold and buying dips in gold. And where should that dip be? Well, probably, you know, somewhere around here, 1850s. The first level is going to be 1881 and then probably 1830. And that's where I see it stopping for the time being and going right back up to the 200-day moving average, a trading opportunity when it arises. Basically until the dollar has topped, and I don't think it will have topped until 10-year gets to that 173 level. I think that's really as simple as that in the dollar. And I don't think yields will have topped until they've seen the 450 handle in the 10-year. Then you can start thinking about buying gold. Until then, I see absolutely no point. And the only question is how far it dips and how oversold it gets. Is it oversold? Of course it's oversold, but it can get even more oversold. So I see no point in buying it until we've seen the bonds confirm that we have a chance of bouncing in gold. I really don't see that gold is that attractive when real yields are going to be as high as they are. And I think that bonds will be better performers than gold once they get there. But there you are. But these levels in the low 1800s are definitely attractive for some call spreads to go back up to the 1900s. DBC signaling absolutely nothing, playing around this 2439 area, up down on a weekly basis, still weak against gold. Tells me that, you know, if we get this kind of level down towards 705, we should get a move back up. That's why I think gold will bounce once we've seen those levels that I mentioned. And I wouldn't get short here for sure. What is oil showing? Oil is basically going back to test the 200-day moving average. But you know, this is the kind of level that you give it a go, 75.16, you buy some call spreads. I don't think that oil is going to be a big mover for the time being. I think it stopped everyone out on the downside first and then on the upside, and I think now it's going to basically go sideways for quite a while, which makes sense because there's very little likelihood that oil starts going much higher when bonds are also going up and the real yield is high. I think that assumes, or that has to presume, that it's going to weigh on the economy at some stage, and that's not really the timing that you're going to start buying oil like crazy. Now, is oil going to collapse? I don't think so. But is it going to go up hard? No. I think the timing is completely wrong. And therefore, I'm doing nothing in commodities. I'm doing nothing in oil. I'm doing nothing in gold. I'm waiting for those levels. But once those levels are achieved in the bonds, I think everything from there can rally. Okay, let's have a look at where we are on the Blue Angels before we discuss equities. We're still too rich, okay? I mean, what is fair value? I don't think fair value is even 18. You know, it's probably something around 17, which is 4,000. With If 10-year notes go to 450 something, I would be shocked if we are not at on top of times 18. Earning expectations can go as much as you up as much as you like, because the multiplier is far more powerful in terms of price. And therefore I would expect this kind of a level just below 18 to be the natural target. I just can't see equities staging a rally from here. What they could do is do 2 or 3 days of upside and then down, but we'll discuss that later in detail. But I just want you to show you that, with bond yields where they are now, I don't think that times 18 is inappropriate, and I think actually times 17 isn't inappropriate. So here you're still rich. Let's start off at the detailed look of the SPX on my clean chart. And why am I showing you this is because every time it drops into this area, it's quite volatile and keeps on going up and down between 34.85 and 42.55. So that's a 130 point range, which is what, a 3%er. So I just want you to see how up and down it goes here and how violent it can be in terms of 3% moves. And that doesn't surprise me at all, because it's a big battleground. Now, I would expect fair value to be somewhere around here. As I showed you, times 18 will be support, and that is just around the 4200 level or just below it. So that is where the big support is, and this is the area of volatility where it's been volatile every other time. And I would expect the same to continue. Maybe a couple of days up, and then, as I said, we test 42.55. Everything I'm saying, of course, is highly dependent on what our friend Jay Powell says on Friday. If he says that our start is actually not too high, then, I guess the market takes it with as a big relief. So then, of course, we don't go down, we rally. But that is, quite obvious. What would I expect in detail? Probably a move over the course of the first 2, 3, 4 days back up towards 43.95, 44.16, and therefore that is probably a good opportunity to buy some put spreads, and then we go down to 42.47 or 42.55, who cares? Maybe even fill this gap down for 42.20, stop everybody below the 200-day moving average, then rally back up to it. That's the kind of move that I expect, simply because I think the bottom in equities is unlikely to be any time before we have seen a bottom in bonds. That is really as simple as I can make it. And back to the Dow. Now, what did I say? If it breaks below 34,712, look out below, buy calls there, because I think that is a level that we will probably visit again. But the only way that stocks can go down is if the most value-oriented index allows it, says that it's going down as well. It's saying basically that. It's saying that it's going down as well. So I would have thought the market goes back up to 34,712. That is going to be absolutely pivotal. If you can't hold there, it's going to go back down to 33,670. If it goes down to 33,670, I think that is going to coincide with the mid 4200s in the SPX, and then we're probably done. So here we have now the stocks. And I think what is interesting is that we bounced off the 200-day moving average. But, really what I'm looking for is this 41.38 level. And this is basically where we were in April before we started going up. Now, if we start matching that with my clean chart in SPX, where were we in April? We were right here, 41 something, so just let's call it 4200. That would match with my analysis that I gave you earlier, that basically we go to the April levels, test those down to 41 38 or whatever it is, and then the SPX can bounce too. Basically, it's saying we go down to times 18 times 17 and a half forward earnings. Bonds get to their extremes, and as bonds stabilize, then equities stabilize as well. That's my best guess at the moment. Basically, my message is let's do absolutely nothing until Friday and let's have a look at what he says. If he does say R starred is, higher than they thought it would be, or if that is the gist of the whole conference, then we know what we do. We basically are hitting the 2024s and 2025 SOFAs. We're expecting the yield curve to flatten as the 2-year takes the brunt. And then we're expecting all the bonds to go to their, what we think is going to be their terminal rate of 10s around this 458 level, and 30s around the 472. And then we're looking for a gradual steepening of the yield curve from those levels, i.e. we are looking for this to be the last flattening. We'll see if that happens. We're certainly looking for the spreads between the 10s and 10s in Europe and in the US to go towards 173. And that would all match with gold being down towards below 180, 181, and that being the end of the move for real rates up, and for gold to have some reprieve and for bonds to have some reprieve. So that is basically what we're looking for. We're hoping that by then we've seen this 42.55 in SPX, and then we can probably buy everything. We can buy equities, we can buy bonds, we can buy gold, we can basically buy assets as opposed to holding cash. Because I think then we will have discounted a correct path of real rates going down, as opposed to the current one, which is too steep. So if everyone thinks that we are going to go, the Fed is going to cut next year very quickly, I think they're making a mistake. And once the market has priced all that out, and I think the likelihood is that they will, then we can have a much healthier market for all assets. Thank you very much indeed, and tweet you on Monday.